Good morning, everyone. Welcome to this update for the 28th of January. And America finished on an incredibly positive note with another surge on Friday night. And as you'll see, the markets are just even more deviated from the 50-day moving average than what I showed last week and the week before that. This really is getting to an extreme level. So this video really is about exactly where markets stand and you know what prudent traders and investors should do about it. So let's jump in and have a look. So the agenda for this week is really should you be taking anything off the table at this stage in advance, or just stay with it until it turns. And I think if you've been watching these videos for some time, you'll know that my view has always been to stay with the market and the current trend until it shows you otherwise. However, the deviation now is so extreme that I think there's a case to be made for doing something a little bit out of the ordinary. There'll be the normal stock and commodity trend update. And last week in Portfolio Analyst, which I got some terrific feedback from, was there was several aspects to it, but building a multi-trade plan. And there was some strong buys in Australia and a couple of good buys in America as well. So it was a pretty well-rounded session that members appreciated. Anyone that hasn't tried Portfolio Analyst yet is of course very welcome to do so. So looking at the American market, the S&P was up 63 points. That's a big gain on the week for such a broadly based index. And the deviation to the upside was it was unprecedented last week, and it's even more so now. This is getting a little bit dangerous, but I do make a couple of comments, and one is that economic conditions, sentiment conditions, and monetary conditions are close to perfect. So the market has every right to be going up. I think it's probably just in the very short term, just going up a little bit too quickly to be sustainable. Now, the US dollar collapsed down through support, and we had massively conflicting statements from, first of all, the Treasury Secretary, and then from Donald Trump himself, who is contradicting himself from several months ago when he did an interview and said he felt the dollar was too strong. Now he's saying that the dollar will get stronger and stronger along with the US economy, which I think most people would tend to agree with. So nobody really knows where the heck the US administration stands now in terms of monetary policy. And as a consequence, we got massive fluctuations in currencies, went one way, then the other, and then went straight back again. But surely the interest rate differentials between Europe, Japan, and America will count for something, and economic growth rates will count for something. Whilst things are certainly getting better in Japan and Europe, it's hard to see them outperforming the States with everything that's going on there. It's a very positive outlook. So I think at some stage the interest rate differentials will count for something, but at the moment the US dollar has broken support and could well go down further yet before we get a turnaround. So let's take a look at those US indices and some currencies. So this is the S&P. Let's look at it on a monthly basis first of all. So that's a really big picture. This is the lows of March 2009. And whilst I'm not a devotee of Elliott Wave, I think it has some elements that can guide us. And you can see we're definitely in the fifth leg, and the fifth leg is engaging in a massive blow off to the upside, even on a monthly chart, which is a really big picture time frame. If we zero in on the daily, you can see just how much it has deviated above the blue line, the 50-day. And as I said last week, I've gone back into the 1990s and I can't find a deviation as large as this one. So you'd have to think that we're going to get some sort of drop. And what concerns me a little is that once that drop starts, that there's so many computer algorithms and people have got so much money on the table that the profit taking could well get very indiscriminate, and we could see 2 or 3 or 4 days of very sharp pullback to the downside, and we get a real cascade of selling that sort of feeds on itself and takes it, beyond the fundamentals. So that's my sort of concern, that this is really a period of excessive deviation. So up to you, but certainly I would give some consideration to taking some profit. Let's look at the Nasdaq. It's also deviated significantly. You can see here was the trend here, and then we started going up at a higher rate, and now we've gone up at an even higher rate again, and I could probably draw another line here. So the rate of ascent of the Nasdaq is getting steeper and steeper. The Russell not joining in quite so much. Actually, I'll look at the QQQ, which is the ETF on the Russell. So actually, that's really quite interesting. This ETF, which covers the Russell, is looking a lot more robust than the Russell index itself. So I'm not quite sure. Oh, sorry, I beg your pardon. This is the Nasdaq. Scratch all that. Let's go back and now look at the Russell. So there's the Russell index, close to all-time highs, but certainly didn't finish with the same surge that we saw in the other main indices either. Turning now to the US dollar. There's the breakdown. We've broken through several support levels. One was this inclined support level, and then this other major support level at 89.5, which really was quite a key level. So now we are looking possibly at getting down here to the 80, 84, 85 mark, which should be another 5 or 6% from where we are now. So this decline in the US dollar may not be done yet, and of course that means strength in the Australian dollar. It means strength in commodities. Turning now to Australian stocks, the the Aussie dollar was higher to 81.1. And that's now becoming a significant problem for our economy. We're in a bad place anyway without our currency going up at this rate. And this must be really causing a big concern for the RBA. And if we start to get any sort of inflationary pressures here, I'm not sure what the heck they're going to do, because if they put up interest rates, the Australian dollar is going to it's only going to get worse. So authorities made the big mistake a decade ago of allowing the Australian dollar to get up above parity, and as a result of the mining boom, and we certainly paid for it when that occurred. Now, our index gained 46 points on the week, but that was pretty disappointing. It's largely flat year to date, so we gained 46 on the week, but from the 1st of January, we really haven't gone anywhere, and it's been very hard work for the Australian index. And you compare that with 7.5% in the US since the start of the year, which is a big move. So a very significant difference between our index and what's happening elsewhere around the world. And a large part of that is because our banks are just going nowhere. So economically, Australia is losing ground to the rest of the world, and it's happening at a disturbing rate. And whilst Treasury and a few other departments, and of course politicians, are making a case for that we're going okay, that really does defy the facts. And whilst it hasn't been too much in the mainstream media, my understanding is that the Christmas retail season in Australia was very poor, and hence you may be noticing that there's just almost constant sales environment now in the retail part of the Australian market. So I don't believe we're in a good place at the moment, and what disturbs me even more is that there's no sign of any political skill or any political will to address the key issues that we have to get back on some sort of better footing. So I despair a little bit for where we sit on a global basis. And I think that must reflect the performance of our stock market. And I've been saying this now for 3 years. I think you really should consider getting outside the Australian market, because there are some great opportunities here, and certainly members of my subscription services have benefited extremely well this year with 6 or 8 stocks that have gone up very, very nicely. But there's not that much to choose from, whereas in America it's an absolute smorgasbord, and also in other areas around the world as well. Let's take a quick look at our market. So the ASX 200. You can see here's this key 6,000 point line. We managed to drop under it on Monday, recovered a little bit towards the end of the week, but it's really lagging very badly, and we're still well below where we were at the peak in 2007. And there's not too many other stock markets around the world that can claim that sort of dubious honour at this stage. Just looking at the Australian dollar, so you can see we've screamed up, and we've closed above the highs of September last year, and you've really got to go back to May of 2015. So it's getting very much to the uncomfortable stage with our currency. Precious metals, gold was higher by $17 up to $13.50, and it was a big roller coaster ride on currencies. The US dollar went down, and then it went up when Trump spoke, and then it went down again when people realized that the US administration's official policy probably is for a weaker dollar, despite what Trump says. And so gold and other commodities were all over the place. But as far as gold goes, there's a degree of confusion. Traders are now, I think, on the nervous side, but there's no denying that the trajectory is upwards in most commodities. Precious metal stocks, there was some small positive movement of the index, but look, I would have expected more. So to me, it's still nothing to get excited about in the gold space. I would just hold some minor exposure. Yeah, you know my views on what the best gold stock is in Australia and probably globally. That's Northern Star Resources, and I think it's comfortable to sit with exposure to that stock, but probably not much else. And the small gains in precious metals indices, or the precious metal stock indices, are going to disappear if the US dollar turns, that's for sure. So let's take a look at precious metals. Let's look at the weekly, gives us a better perspective. So we still need to get above this 1380 level, which is the 38.2% retracement of this whole run down from the big peak in September of 2011. At just over 1900, we got down to 1059. So this is the first rebound, and you can see we went there in 2016 exactly, pulled back, and we've now been forming a rising triangle. So certainly the pattern is quite suggestive of a breakout above 1380. But what isn't really filling me full of enthusiasm is this. So we're seeing a similar sort of pattern in gold stocks, but as I've said many times, gold stocks will lead the underlying metal in both directions, and I'm just not seeing the strength in the gold stock indices to suggest that the big players are coming on board with that trade. So until that happens, I'm not overly hopeful that we're going to see a breakout in gold. Other commodity prices, copper was up slightly to 320. Crude oil moved up strongly at the end of the week to 66.14. So fired up again by the currencies there. Energy stocks were reasonably steady. There was a couple went higher, but mostly steady for the week. So we'll take a look at XLE. There is the spot copper chart. Not a lot happening there, and quite a strong 3-month trend, as you can see, from around 54 up to 66 in crude oils. That's been quite a good move. Let me just take a quick look at XLE. So this is the overall energy index, so that includes the explorers and the service companies. So we're pushing up to resistance here on XLE. Not that resistance and support levels necessarily are as meaningful on an ETF as they are on individual stocks, but nevertheless we're pushing up there, and in fact XLE was a little bit lower on the week, which is really quite insightful, because I think we may see the crude oil price follow suit. But certainly you want to have some exposure to this space. I believe we may get a pullback. It may consolidate here for a few months. I don't know, but I would expect, on what I see now, that we will see a breakout, and we will see XLE start to move up into this area up here, up towards 90 and 100 over time. So to finish it off, the current positioning, I confidently expect the trend to continue, the medium and longer term trend to continue, but the short term is at a crazy extreme. China tech stocks look fabulous. Alibaba broke out during the week and really went on with it, surged above $200. So I'm not too concerned about the Chinese listed stocks in America. But there's a lot of other parts of the American market that are a bit frothy. So I would consider some profit taking to reduce your exposure. Maybe get in there ahead of the curve, and probably best to do that with stocks that have deviated the most to the upside. Would be my suggestion. But this is only short-term maneuverings, just to lock in a bit of profit, give yourself a bit of cash when the inevitable correction happens. I mean, who knows? Maybe the S&P will just go sideways and let the moving averages catch up for a few months. But I'm just concerned this extreme is so great that the computer algorithms won't take much, and we could get quite a sharp sell-off to the downside. You'll wake up one morning and there'll be a substantial move, and there won't be a lot you can do about it. Portfolio analyst this week. I'm going to be taking a look at Australian mining services, amongst other questions from members, and a few recommendations of my own. So once again, if you haven't availed yourself of the 2-week free trial, I think there's a lot in this service that you might like. There's my contact details for those non-members who wish to get in touch with me, and I'll be back with you next week. Cheers.